Welcome, everybody. Thank you for joining us today. We'll go ahead and get started with the CGAP webinar entitled Agent Network Journeys Towards the Last Mile. My name is Emilio Hernandez, and I'll be a speaker and moderator today. And I'm joined with a distinguished group of experts who will share with us the cross-country experience on how to promote agent networks in rural areas. So let me just go over the agenda for today. We have a three-part webinar. In the first part, we'll present the CGAP synthesis on how this cross-country experience helps us answer the question, how to promote agents at the last mile. And then we'll move to a panel discussion where our guest speakers will share with us cross-country learnings from China, Colombia, India, Indonesia, and Kenya. And then we'll conclude with a question and answer session where all of you can share your comments and questions with the speakers. So let's go ahead and get started. First, let me introduce our speakers for today. We are delighted to be joined by Beatriz Marulanda, CEO of Marulanda Consultores. Beatriz headed the team that advised the Colombian government in the design and implementation of Colombia's financial inclusion policy. And she was also part of the team that helped in the design of the Colombia's Gdp payment strategy through deposits into savings accounts. Also with us is Wright, founder and managing director of MSC. The MSC team led the acclaimed Agent Network Accelerator program, which has studied agents in over 17 countries. Graham pioneered much of the market-led approach used by MSC. Also with us is Deng, who leads DFS Lab's investment initiatives in emerging markets, including venture, sourcing, and selection. Prior to joining DFS Lab, he was a technology consultant for the Gates Foundation's Financial Services for the Poor team and an economic consultant in Silicon Valley. I've already introduced myself, just to say that I'm here in the capacity as CGAP's lead on its program on agent network innovation. So I'll start with this first part where we try to answer the question, how to promote agents at the last mile. So to answer this question, CGAP started almost 2 years ago its Agent Network Innovation Program, where the objective was to start a global stakeholder dialogue and then conduct 5-country deep dives that would help us identify what were those features or universal principles that allow agent networks to operate viably in rural areas. And then through the country case studies, which we did in partnership with our guest speakers here present, understand how industry stakeholders could enable such features. And this is how we came to the realization that there are different ways of achieving agents at the last mile. But a key driver is that initial use case that is so appealing that it sparks traction in the industry to make investments in rural agent networks. And also, who is the provider that is, in that particular context, best suited to deliver that use case? That is how we recognize broadly 3 main journeys towards agents at the last mile. The first one I'll start with is the Gdp Led Journey, and this is best exemplified by Colombia and India, where it's the government's desire to increase subsidies to rural beneficiaries through bank accounts that really sparks industry traction towards agents at the last mile. And in this particular context, it is banks who lead this process. Now, in Colombia, that significant public sector investment was very well leveraged by private sector banks who now have more active agents in rural areas, whereas in India, it is the public sector banks who dominate rural agent network coverage. The second journey is the P2P-led journey, exemplified by Kenya, where the critical use case is that P2P transfers catering domestic remittances markets, right? Now, in this case, it was a mobile network operator, Safaricom, who led this process. And Safaricom realized since the bulk of the transfers of remittances were going from urban areas to rural areas, it had to make significant investments to incentivize rural agents' operations. The third journey is called the e-commerce led journey, best exemplified by China, where e-commerce firms who have already established themselves well in the big cities now look to expand into rural areas as a growth strategy. And they set up service points or agents that initially help with the logistics of e-commerce, but then are enabled as financial agents once e-commerce firms enter financial markets. Now, this journey is pretty mature in the case of China, and we do see that the e-commerce agents came with more efficiencies that help viability in rural areas and help expand that rural frontier. We argue that in the case of Indonesia, this journey is in very early stages, and even though the financial sector in Indonesia is dominated by banks, e-commerce players are playing a dominant role in trying to enter more and more financial markets, and they have established these e-commerce agents that show more efficiency that could be translated into future rural agent network expansion. But so far, we have not seen that, so it's going to be very interesting to see how that market evolves. So what does all that cross-country experience tell us about how to promote agents at the last mile? I'll start with two general thoughts. The first one is that no journey is better than the other. All of these three journeys were successful in their own right at solving for very specific market constraints. The second thought is that to really understand what promotes rural agent networks, you cannot see them in a vacuum. You have to link them to the other building blocks of a digital finance ecosystem. Now, if you do, we distinguish 6 policy and regulatory levers that have been extremely enabling throughout. The first one refers to public investments, and there are 2 types here. Public investments in the form of subsidies for providers and agents to start rural operations. And that helps accelerate a learning process from the provider side that will lead to more efficient agent models. The second type of investment refers to interoperable payment systems and rural bank branches. Interoperability is important because it helps connect providers with a growing and diverse agent networks across the country with very different profiles. And that helps agent network expansion. And also customer account connectivity in different parts of the country helps drive cash in, cash out transactions at the agent level. The rural bank branch infrastructure is critical for agents to manage their liquidity because ultimately, at some point, all agents need to visit a bank branch to balance their e-float. The second lever that we highlight is the channeling of G2P through various provider types. G2P transfers can really complement in a big way the existing transactions that agents offer on behalf of DFS providers. And that helps a lot with agent viability because it increases revenue per customer. And this is critical in rural areas where agents cover fewer clients in their area of operations. Third, regulation is more enabling when it allows new agent models irrespective of provider type. All of the agent model innovations that we saw can trace back their origins to early regulatory moves that allowed new players to come into the financial space, bringing in new models and new agent profiles, right? And that sparked competition and it sparked innovation that contributed to the progress that we see today. The fourth lever I'd like to highlight is the collection of agent profile data. Providers, policymakers, and regulators can benefit a lot from collecting agents' geolocation and business profiles because it informs how the agent landscape is changing over time as the agent network expands into rural areas. This is useful to inform regulations that are more tiered for the different profiles of agents and allow the coexistence of them all. It helps agent network coverage. And it also helps policy tailor or target better their support to agents by recognizing which is the agent profile that is better suited at covering rural areas. The fifth lever that we see is that it is critical to continue diversifying the use cases in order to promote rural agent viability, meaning that cash in, cash out is only a function that allows a customer to use the valued digital financial services. The more digital financial services of value there is, the more transactions agents will see. And finally, providers must support agents to do specifically liquidity management, onboard new customers, and prevent fraud. Because on these three fronts, agents by themselves have very limited capacity of addressing these dimensions. And these are critical for great customer services. So I'll stop there with the big picture, and now we will transition into our panel discussion, where we'll go deeper into these ideas by bringing into light the specific examples from the countries we studied. So I'll direct myself to our guest speakers, and I'll stop sharing my screen so that you can see speakers on your video. Just one moment. Okay, so hopefully everybody has the layout and can see the video of the person who's speaking in their big screen. So maybe Daniel can just double check that that's actually happening. But my first question goes to Beatriz. We'll start by talking a bit about what led to the progress that we see today in each one of the countries. And in case of Colombia, Beatriz, could you tell us a bit what has been the achievements in terms of agent rural coverage and financial inclusion in Colombia, and what were the success factors specifically for this country?
Thank you very much, Emilio. Hello to everyone. I would like to thank CGAP for inviting us and for allowing us to do this research. And I would like to thank very much the financial institutions and the agent network managers who allowed us and provided all the information that was used to this analysis. Going to your question, I would have to mention certain characteristics of how the journey in Colombia has developed. Underscore that, as you mentioned already, it has been a bank-led model. Although in the last 2 years, one starts to see e-money issuers and fintech companies starting to take advantage of that network that is already available. Mention that also that by 2015, with 1,100 municipalities we have in the country, by 2015, we were able to have coverage, financial presence, let's say, in all of them. And in 263, the agents were the only type of financial presence available, and that continues to be so. And also, kind of a third factor, which I would like to underscore, is that one needs to acknowledge that this model is has a very strong urban emphasis, with cash-in transactions being the predominant ones. But then going to the rural setting and the topic of this study, what really we find in Colombia is that, as you were saying, the sparking elements that started the whole development, one needs to recognize the role of the government, not only in terms of regulation, allowing really a very good regulatory framework that has been maintained, and even in February this year was even opened more. But also with incentives, because at the beginning, 2007, 2008, banks really had a difficult time understanding how to manage this channel, the risks involved, and going to rural areas really sounded impossible. So at that time, two factors came in. The G2P program called Familias en Acción was expanding to rural areas. It needed cash out facilities, and it asked, let's say, the financial sector to go out. It wasn't easy. So at that time, also, Banca de las Oportunidades, how the financial inclusion policy in Colombia is called, was born. And it launched a set of incentives to, let's say, subsidize and also lower the risks for those banks extending or wishing to expand their network to rural settings. That was very important. But from that spark, that initial spark really initiated by the government, one then needs to acknowledge that private banks came in. Private banks understanding this new network they were going to manage, this new channel they were going to manage. And one can see that two kind of strategies evolved. One, finding banks that use agents mainly to redirect cash transactions out of branches, looking for a lower cost channel. But on the second hand, also a few banks that understood that this channel could be a strategic partner to penetrate new segments and penetrate new geographic areas. And that's kind of the interesting fact. How do they do that? Basically, we underscore two types of models. One, a direct model, where each bank has a division in the bank that goes out, looks for each agent point, provides technology, signs a contract with each of the agents, and manages his own network. That's what we call the direct model in Colombia. And second of all, the typical agent network manager. That is when banks know that they cannot aggregate enough transactions to this channel, so they link and they find network managers that have specialized in linking and finding mom-and-pop stores, pharmacies, groceries to undertake cash-in, cash-out transactions, where these agent network managers are able to aggregate financial transactions with non-financial transactions, starting from top-ups, lottery sales, remittances services. So these two models have emerged, but the most interesting fact we found in the study when analyzing detailed information is that the direct model, contrary to all initial hypotheses we had, it's the direct model that resulted in a better and more sustainable rural model. Why? Basically, because what we found is that the bank that decided to do this took the strategic decision to accompany the model with a mobile commercial force to help the communities to strengthen the value proposition to the communities, sell products, advise the clients, provide advice and information, which then, and this community buying the product sold by this financial institution was able then afterwards to do cash-in transactions, cash-in or cash-out transactions at the agents. So this we found was very important. It resulted in higher usage, greater diversification of transactions, and therefore greater balance in the liquidity. So that I'll stop there and let you go on, Emilio.
Thank you. That was very revealing. Graham, turning over to you for the Kenya and Indian experience, what do you think were the provider innovations and policies and regulations that further rural distribution in these countries, and how did they differ between these two?
Thanks, Emilio, and thanks to you and all the team at CGAP, as well as my amazing team in Kenya, Indonesia, and India. So that's Anup, Raunak, and Nitish, as well as the providers A&M who helped us conduct the research. So if we take Kenya first, Kenya saw a perfect storm for digital financial services with a conducive environment, regulatory environment, a dominant player, and the evolution of innovative use cases. So initially, as many know, M-Pesa was developed to facilitate loan repayments for MFIs, but integration and reconciliation problems meant that Safaricom and Vodafone quickly pivoted to a use case we saw during the pilot, that of people in cities sending money back to their relatives in the villages. Now, as I noted before, policymakers and regulators adopted a test and learn approach. And furthermore, initially, the regulators supported an inclusive agency banking sector as well through steps like banning agent exclusivity, ensuring pricing transparency, etc. So this allowed the banks to also participate in the market. So I think also an unintended factor for the growth of mobile money at the beginning, especially M-Pesa, was the need for people to send money up country and within cities and towns during the post-2007 election violence that racked Kenya. In that post-election period, other means of sending money, traditional means like bus drivers and conductors, failed, and so people had to resort to using mobile money. So the first effective use case for M-Pesa was to send money home. Thereafter, a number of use cases have been developed for users across the spectrum of get, spend, save, borrow, protect, and invest. To do this, from about 2008, Safaricom began partnering with FMCGs, banks, remittance providers, and fintechs, the latter in particular using the open APIs that Safaricom put in place. And some of these were even competitors, but it allowed Safaricom to increase their range of products on offer and ultimately thus the distribution network and reap mutual benefit with the partner organizations they worked with. Safaricom competed on enhancing its presence and evolving the product range in order to meet the needs of low and moderate income clients throughout Kenya. So now you have a situation where 9 out of 10 Kenyans are able to access some form of financial services due to the ubiquity of mobile money. And 79% of people in Kenya have a mobile money account. Now, in the context of rural penetration, service providers took measures to enhance agent networks across the country. So, for example, at the beginning, Safaricom mandated interested applicants to set up 2 rural kiosks for every 1 urban kiosk or agent outlet that they established. Recently, the government has begun to digitize its G2P payments, but only 4 banks were selected as payment service providers for these key programs. But this allowed these players to begin expanding their presence in rural areas through using agents to disperse social benefit. So you can begin to see the beginning of that recurrent G2P catalyst, even in Kenya. So where are we? In 2019, at least, for which is the latest data, there were about 225,000 MNO agents, so mobile network operator agents, and about 50,000 bank agents, of these about 30% or a third or so were in rural areas. So now let's turn to India. So the journey of CICO networks in India really can be seen in 2 parts. The foundational years between 2005 to 14, which saw the emergence of the required regulations and very basic savings and remittance products, as well as enabling technology and what initially was called the branchless channel. The period between 2014 and March 2020 saw wholesale changes in the landscape as a function of 3 major developments. First of all, there was the launch of the flagship PMJDY program. And since 2015, when the PMJDY, the Indian government's financial inclusion program was launched, 382 million people have opened one of the basic Jan Dhan accounts. And 59% of people who open these accounts live either in rural or semi-urban areas. The second was the government push for delivery of direct benefit transfer to citizens in a growing number of welfare schemes, including Cash for Work and the Ujjwala LPG program. And this was further accelerated, obviously, during the COVID-19 crisis, so that in April 2020, the government was able to use this existent infrastructure, and banks processed 411 million cash-out transactions to deliver over $4 billion in emergency payments in just 1 month. The moves to digitize these cash benefit transfers continues apace, and MSC is working on this with a wide range of ministries, including the Ministries of Food, Fertilizer, and Fuel. And then the third underlying foundation of this burgeoning of the digital infrastructure was the Aadhaar-enabled payments system. Aadhaar, as many of you know, is the national biometric identity system, and that has effectively created an interoperable payment system. And the Aadhaar-enabled payment system, the number of transactions grew by 133% during the pandemic. Now, since 2016, one major factor has significantly supported rural inclusion efforts, and this is the massive growth in reliable telecommunications network coverage along with cheap data access, which is driven primarily by Reliance Jio's entry into the market. And I think we tend to sometimes underestimate the importance of these basic infrastructure functions. So where are we now? India has an almost 1 million strong CICO agent network with about 540,000 of those agents, so about 54% of them in rural areas. And that CICO agent network has grown at a compounded annual rate of about 36% since 2010. But there are some interesting innovations going on that I think are worthy of note and really important. And I'm going to highlight two. The first is Adyati, which is a traditional agent network that operates in 26 states covering 50,000 villages. And that's been able to leverage its local presence to offer savings and credit services on behalf of a bank. Now, a lot of the traditional agents play that role already, but the difference is that now Adyati is beginning to support the delivery of small-scale credit from its agents and support the loan transactions through its agents. So now it's become, rather than just a seller of products, it's a facilitator of lending. And the second, I think, really important change we've seen, and this was accelerated during the COVID emergency, was the emergence of new age agent network managers. Now, these use technology-enabled products, the Aadhaar-enabled payment system, the Unified Payments Interface, UPI, and so on. But they also use technology to onboard, train, and monitor their agents remotely. So that helps them scale up agent networks fast and at relatively low cost. So in contrast to traditional agents who offer the full range of banking products and services, these new age agents focus on simple transactions like cash in, cash out, and bill pay. And combining those two, we can see the beginning of a two-tier differentiated system of sales agents who sell the product and service agents who do the basic cash in, cash out to service the product that has been sold by their more sophisticated peers.
Thank you, Graham.
With that, I'll stop.
Thank you. No, that was very enlightening. Now, just to contrast this with the Chinese experience, I'd like to call on Stephen Deng. Stephen, so being China one of the most mature digital ecosystems we observed, can you summarize what are the achievements in terms of rural agent coverage and financial inclusion, and what led to this progress in China?
Sure, Emilio. Thanks so much for the opportunity. This is a great project for us, and I think it's especially important given the post-COVID world that we're all having and last mile cash in, cash out that will have to evolve. I'd also like to give a shout out to the partners that we worked on with this project, so that's the Chinese Academy for Financial Inclusion, especially a researcher named Deng over there who was really critical in getting all this work done. But to start answering your question, so China is immature in terms of coverage for last mile agents. It's about 97% covered by official statistics. This is about 1 million agents scattered across the country, mostly in areas with higher economic activity, but with that 97%, you'll have pretty strong rural coverage. Just to give you a sense of how activated folks are in China, about 2 years ago, there was a survey that said about 2/3 of people have used digital payments in rural areas. And about a year ago, you had about 19% of payments being in cash, right? So you see a country that's gone very digital. I'm hearing, am I hard to hear? I hear some people. One sec, let me.
A little bit, yeah. It's breaking up a little bit, but we can make sense of what you say.
Okay, I just turned on my mic a little bit.
Yeah, that helps.
So, with that 97% coverage and 1 million agents out there, how do we get to that point? So first is, I would say that I would break it down into 3 different phases. And to preface this all, there was, a lot of banking regulation and reform that happened from the 70s through to kind of the early 2000s that really helped rural banks get off the ground in very, very remote areas. But in 2008, there was a Gdp program, surprise, surprise, that really transferred their main welfare program from a card-based program through to an agent-based program. And so people were required to go through agents in order to get their welfare payments, which really started to activate, I would say, very last mile folks to open accounts and start to utilize agents in a way that didn't happen before. And those agents were really just doing the cash out for different welfare programs around the country, but it did mean that the government had a mandate to ensure that coverage was very high, and it also meant that they were working with the banks very closely, the rural banks and the large state-owned banks, in order to make that program accessible and successful. And that kicked off a lot of the agent expansion between this kind of 2006 to 2014 period, which is very critical. But the next period, I think, is really the inflection point in China, which is from about 2014 to 2016. And this is what the one that I think everyone talks about. This is when, Alipay and WeChat Pay really kick off. This is when the country is really thinking about a post-cash future, like the vision started to come together. And what you saw were 2 different forces here. One was the government realized that digital payments were starting to rise, especially in urban areas, right, where the use cases were the most popular. And at the same time, the payment companies really started to realize that the agent network was such a useful piece of infrastructure. So what you start to see is the agent network becoming something that wasn't just built to purpose, which was G2P, it was starting to become infrastructure. And that story will continue as I move on to the next piece of this story as well. But if you look at policy during this period of time, it went from we are going to create a universal kind of accessible agent network through to we're now going to create a universal agent network that really services digital payments. And so the government started to open up the types of services these agents offer. Things like bill payments, things like credit, things like other pieces of payments, P2P transfers. So agents played a role there to start to train folks how to use digital payments in light of the advances of the private sector, right? And so they really worked hand in hand in this period. And the government should be noted that this latency period was very regulatorily light, I would say. There was a lot of room for innovation and growth. The next period that I'll jump to, post this, was kind of 2016 to now, which is what we're talking about, the e-commerce-led revolution here, right? It kicked off with a more tightening regulation, actually because P2P became somewhat of an issue. There was a P2P crisis in China around that 2016 period, excuse me. But what you did see was agents really became infrastructure at that point. And here, people were building not only just on the physical presence of agents doing cash in, cash out, but also the infrastructure of digital payments that were happening in rural areas. And this is when you start to see e-commerce really work, right? You start to see things like Taobao villages. There are a lot of new models that are popping out, Pinduoduo, that utilize those two core pieces in order to not just deliver digital payments, but product delivery, sales, after-sales services, things like that that build on that infrastructure. And to kind of complete the circle, during the GDP period, agents were very, very subsidized. In low activity areas, not very profitable. Still to today, very low activity is hard. To today, when you see at kind of this e-commerce led model, agents have multiple different revenue streams, and that is a huge difference. And you can find out that the government played a huge role throughout all this, and in the final area, you can see that their training programs shifted, right? In the payments piece, they were really talking about digital payments and how to get people to switch. In the e-commerce piece, there's a lot more training on sellers, for example. How do you get people to sell online? How do you ensure that trust can be built remotely between sellers and buyers who've done this for the first time? And that's a huge piece of this as well. So I'll stop there.
Thank you. Thank you, Stephen. So the last country we would like to cover is Indonesia. So we go back to Graham, and I think there are interesting links with the experience of China. Graham, in the case of Indonesia, what were those critical foundations, and how much progress has Indonesia made in agent network coverage?
Great. I mean, a really good question, and particularly difficult one, given that at present the government of Indonesia continues to promote a bank-led model, and at the same time regulations have limited the penetration and use of agents. Now, many of the e-commerce players in Indonesia have actually built extensive agent networks, although their presence in remote rural areas remains limited. And in order to achieve sustainability and expand the range of services offered, many banks and e-commerce agent networks are now collaborating. So, for example, Bank BNI is working with Grab Kiosk, Bank Mandiri is working with Bukalapak, and so on. And these arrangements are really useful for large state-owned banks that have a limited branch network, but also a large G2P mandate. So there's much excitement around the sort of 2.4 million e-commerce agents, but actually when you start doing detailed analysis, only about 280,000 of those are active and individual outlets. So there's a tendency across most surveys to overestimate the number of agent outlets by double counting those that serve multiple providers. And this is something that the geospatial analyses need to pay careful attention to. And actually, of the 280,000 agents, only about 220,000 of them are viable, according to the research that MSC did along with BCG. Now, for these reasons, dormancy, churn, and double counting, as I say, geospatial analysis of agents routinely overestimates the number of agents outlets in all countries. So we need to be very aware of that. The major use case for these e-commerce agents in Indonesia continues to be bill payments and mobile top-ups. And these are both low margin and highly competitive transactions, since many, many provide these services. So in order to differentiate their network, they would love to offer core banking services as well. And similarly, e-commerce players are also experimenting with digitizing MSME value chains, although this is early days, and we'll have to see whether these initiatives can mature and achieve scale. But even for digitizing value chains, banking partnerships will be essential in order to create more flexible options. And of course, without banks, the system will remain closed loop and not very practical for SMEs. Now, the partnerships between banks and e-commerce players continue to be in a grey regulatory area, as the services of third-party agent network providers are restricted. Theoretically, banks can bypass this, provided that the bank can manage to have individual contracts with each and every one of the agents. Furthermore, at the moment, the regulations mandate exclusivity, and so the non-banks will have to enter into exclusive contracts with individual banks, and that also might impact their sustainability. So yes, one can see Indonesia inching towards an e-commerce-led approach, but it's not, I think, as close as we would all like it to be, and there remain many challenges.
Thank you. So we've taken a look at what have been some of the achievements and innovations and progress on agent network reaching quality. Now let's turn to what can each country learn from each other, right? And I'd like to go back to Beatriz for this. Could you mention what are some of the remaining challenges to keep extending CICO networks in Colombia, and how what you heard from Stephen and Graham may help, or what lessons from these other countries may inspire new thoughts for progress in Colombia? Beatriz, over to you.
Thank you, Emilio. Well, we identified various challenges, by the way, with the stakeholders when we did the study, but I would like to highlight at this moment precisely the challenge of continuing expansion and reaching greater capillarity, both in urban areas, but obviously especially in rural areas. And also being able to achieve greater usage, precisely because in our terms, that reflects value proposition to final clients. And in that sense, what we think is that has been kind of reaching a frontier because of the model used, or not model, the type of contract that is used for signing in agent networks, where predominantly Colombia has used a postpaid model, what we call postpaid model, which means that the financial institution extends a credit line either to the individual agent or to the agent network manager. And that means that the frontier is reaching mainly formal merchants, because those are the ones that really can sustain a credit risk analysis. So in that sense, we think that the frontier has to move. And going to a second question, where can we learn that? Well, the Kenyan experience, I think, in terms of postpaid models, but really understand what we saw in the rest of the countries is most of them operate under a prepaid model. That is, that the agent buys the float with which to operate. This is important in the case of Colombia because we think this would avoid concentration. Going back to Graham's overstatement and double counting in agents, what we found in the analysis we did is from the 1,800 agents reported by December 18, when we used all the data provided by, especially by agent network managers, what really we found is that it's really, the agent points are only 52,000. So an important job in spatial analysis and location would be important. And I think from that, what we would be seeing is kind of a tier type of structure where you would have prepaid type of agents working on simple basic caching transactions, and the normal postpaid type of agents working in more sophisticated type of value propositions for final clients. What have we learned from other countries? What we found very interesting is to identify that in India, what we find very weird, which are the specialized, we in Colombia, specialized exclusive agents are the norm in India. And that is kind of the latest development in the agent network model here in Colombia, in urban areas, finding just specialized financial transactions agents. And that in India was important, but also to highlight the way that India is expanding aggressively using technology. And that for what we call the mobile agent networks that were authorized in February in Colombia, I think would be a very interesting experience to analyze better. Secondly, how the public banks in India have allowed their branch network to provide liquidity services to all the agents, no matter who they belong to. This in Colombia has not been achieved yet, and that implies high cost structure for the agents in rural areas. From the Kenya example, as I already mentioned, obviously the prepaid model, but also how a closed loop model, ecosystem, with which obviously M-Pesa grew and came of age, as some would say, kind of plateaued, and it requires interoperability, and interoperability with other type of products has enabled it to grow, and that is something we should take into account. And finally, from Indonesia, I think we are seeing there, although as Graham was mentioning, banks have not been allowed in, expansion based on e-commerce and fintech platforms. The high rates of expansion based on an agent cash environment is necessary and could imply greater opportunities for the future. I think those are my main points.
Thank you, Beatriz. Very interesting links, which highlight the relevance of conducting this type of cross-country analysis. Graham, over to you in terms of you already started hinting at some of the challenges that remain in India and Kenya, and maybe you'd like to add a bit more, but highlighting what are the lessons that shared by Stephen and Beatriz, how do they resonate in these two contexts?
Yeah, I mean, as you said, it's been a very interesting exercise to compare the different countries. So I think Kenya can learn from China and Colombia. One, as providers expand agent networks into rural areas, there's clearly a need to enhance and increase use cases for digital money in order to sustain the CICO agents business case. And the transition of Chinese rural agents from subsidized CICO to open network that enables e-commerce is an approach that the market in Kenya may take to enhance use cases for rural agents. But as Ron has just pointed out in the chat box, the vast majority of transactions in Kenya are still in cash. Now, I think also service providers may enable agents to increase their income through these e-commerce, through the delivery, aggregation services, order fulfillment, customer service, and so on behalf of e-commerce companies. But, we'll have to look at how that is best done. And there are companies beginning to work on that in Kenya already. But considering the limited and operational and economic viability of agent networks in remote and rural locations, there's a need to encourage providers to expand these rural networks still further through subsidies in form of setup costs, additional commissions, one-time costs, investment in infrastructure, etc. And I think both Colombia and China highlight how incentives and co-financing schemes are required to encourage providers and agents to set up in remote rural locations. Now, one could argue that the government of Kenya's GDP programs are beginning to do this because they take the route of a tender process to allow people to bid to offer services to disperse GDP in remote rural areas. So turning to India, cash out remains the predominant transaction in rural areas, and these transactions are typically time-consuming and not terribly remunerative for agents. So again, there is a need to broaden the scope of services available through agents. Agent commission on generally, and particularly on B2B programs, is still low and probably not enough to sustain the interest of the majority of agents for a long time. So adding things like we've seen, the sourcing and servicing of credit on behalf of banks could be one of the key drivers. And secondly, as we discussed before, that tiered, differentiated approach so that you have dedicated agents offering the sales of these products and then non-dedicated agents who have this agency as an add-on to their small shop or whatever, servicing those products may well be a way forward. But ultimately, particularly for direct benefit transfers, the commission rate needs to be increased. And there have been countless commissions and studies on this, and the Indian government still hasn't done it. I think the preference for dedicated agents in rural areas amongst public sector banks means that these agents incur higher setup costs. They're often required to have computers and power backup systems and so on. So they're going to be able to function on a sustainable basis in the sort of market towns, but not at the periphery. And so again, you need this combination of these traditional infrastructure-heavy agents that are selling services and the new age, non-traditional, non-dedicated agents that actually typically sponsored by private sector banks to provide the servicing of those products. And then finally, there is still an absence of reliable and accurate information on agent outlets that are actually operational across India. And so if China or Colombia have figured out a way of doing this, there are clear lessons to be learned there as well.
Thank you. Over to Stephen. Same question to you. Can China learn anything from anybody else?
I think the answer is of course. In many ways, China is becoming a victim of its own success, where the impressive expansion of digital connectivity and the agent network has meant that the muscle to work with, I would say, underbanked folks, I think has become less strong. So if you look at where some of this stuff is the strongest on the the eastern coast of the country, and where you have most economic activity. This is where you have most of the large urban centers. And when you move further west, you're starting to see less income that can be spent on things like e-commerce. You see less folks utilizing their bank accounts at the same rates. And so there is a lot of work being done trying to understand how to work and better incentivize folks, let's say in the most eastern parts of the country, to be a better and more inclusive part of this whole ecosystem that's being built. And I think a lot of the lessons from Indonesia, from Colombia, from Kenya really relate to that less digitally enabled individual. And I think especially how cash out is still core. I mean, I think that is still a truism across the country, especially for folks who maybe interact with another proxy to the digital economy, but in reality are still using cash in their day-to-day, every day. And so how do you ensure that those people are not left out as the rest of the country digitizes? I think there are a lot of lessons, and we see that already in Indonesia, where they have much less of a banked population, but they are very much expanding into rural areas with different value propositions for those folks. And I think that's certainly something that the country will continue to look at.
Thanks, Stephen. So just a quick reflection. It seems like looking at some of the questions, and before we go to the QA, you mentioned about that digital divide. Do you think that the Chinese example is a good one in terms of not falling into this rabbit hole of saying, well, agent networks are somehow preventing the digitization of services, or is it the other way around? Are they enabling the digitization?
Yeah, it's good. It's a great point. I would reflect on what people want from agent networks and what do people actually want, right? Is really the answer here. It's every country has different value propositions for last mile consumers and last mile SMEs. But I think one maybe overarching point is that income generation and increasing quality of life is something that is generally wanted, and when you try to make changes to how you sell, how you buy. And I think agent networks have been a critical piece of that, especially in last mile in China. I think we'll continue to be a part of it because, like I was saying, even as the country gets to this 90+% cashless rate, there are many folks who would just interact with that economy in order to sell. And in order for them to utilize the ability to sell digitally, they still have to interact with the cash network in some way. They're probably not going to be able to buy inputs with digital anytime soon. So there needs to be this fluidity across the informal market cash network and this larger digital network, especially if you want rural to urban commerce to effectively change what people are making. And so I think if I could take one thing from China to help the other folks that are kind of thinking about policy, et cetera, it would be focus on how income is being generated, especially on the SME side, and how this online to offline fluidity has to happen. And it'll happen in different ways across different countries, but it has to happen.
Thanks, Stephen. Well, with that, we are just in time to start our question and answer session. We've been receiving questions on the chat, and I've taken note to a couple of them. Please keep on sending them. We're looking at each one of them. But I'd like to start from this question around the link between OTC, over-the-counter transactions, and wallet transactions, and this dilemma that you can see. I find it more prevalent in the P2P led journey, led by, let's say, MNOs or third-party providers using mobile networks, where there's a perception that OTC transactions affect wallet-to-wallet 100% digital type of transactions. Does that tension limit the growth of the digital economy? I guess the question is directed at all three of you to share your thoughts. Who would like to start? Maybe.
I'll try the first. I'll try it. I'm not sure if it's a false dilemma or if we're posing a difficult question. In this sense, in our economies, we have, as Stephen was mentioning, the informal economy versus the formal economy. And we cannot really avoid that in the sense that the informal economy depends and uses cash all the time. What is the value proposition to let them go away from that? I don't think it's the wallet the product in itself. It's many things around the product. Does a wallet really, for example, give me access to a credit that will allow me to increase income, for example? So I'm going to use the wallet not to pay if the person I'm paying to is just the same person that I always pay to in front of me. But obviously, if I start needing to buy e-commerce things, if I need to, as the COVID experience showed us, at least in Colombia, the wallets started becoming very used because you could not pay otherwise. So I think the wallets need the agent cash infrastructure, at least in the initial stage, because people that do not have access, that live all the time with cash and do not have access to the cash as fast as they usually do, they will not have confidence in the wallet. So it's kind of a symbiosis. You need the cash outlets to make the wallet viable. The viable wallets need to have a very strong value proposition to be able to get the clients just interact all the time. And it needs a cash in, forceful cash in, I don't know how, but somebody needs to put cash into those wallets, which I don't think will be necessarily the people that are not using it for far apart transactions.
Thank you. Graham, maybe your perspective, having looked at the Kenya market closely.
Yeah, someone has just written in the chat. Safaricom from the get-go really pushed hard to ensure that people had wallets and really tried to minimize OTC, over the counter. But we do need to differentiate between two types of over the counter. One is like you have in Bangladesh, where I rock up to an agent, give them some money, and they use their account to send to another account. The other is what is actually still very common in Kenya, despite its long-term association with mobile money, which is agent assistance, where I go to an agent with my phone and say, just help me walk through these steps to sending this money to this utility provider or whatever it is. And the latter, I actually think, is really important and probably will stay with us for much longer, particularly for very poor people, the oral people who are illiterate and innumerate, people who don't have digital capability or are rarely interacting with these sort of digital ecosystem. So I think it's important to differentiate between those two types of OTC, and one I think is a problem for a whole variety of reasons, including fraud and money laundering. But the agent assistance, I think, is actually really important. It's an on-ramp to digital capability, and I think it'll be with us for a while to come.
Stephen, your thoughts about this dilemma?
I mean, I'll quickly add that the Chinese model has people's bank accounts linked to all of the agents, right? And so there's less of an OTC, but I would say what Graham was saying is still very prevalent, this assisted agent transaction, right? Where, especially in areas where this is still occurring, the agent is usually a very trusted person within that ecosystem. And so there is a lot of informal and formalized assistance in order to make transactions happen. Like I was saying, during that 2014 to 16 period, there was a lot of training on digital payments, but there will always still continue to be groups that are somewhat left out, usually older populations, oral-only populations, like Graham was saying. So I think it's here to stay, but you can clearly see the value of the wallet gaining, especially when people are starting to purchase more from that wallet. So as you're seeing more use cases of the wallet, digital top-ups, direct usage in order to buy goods, I think the wallet becomes a much more familiar thing, and a lot of it is trust in the end, right? We saw cash on delivery in China, for example, a kind of corollary issue, which is people still wanted to pay cash only when they received items. And cash on delivery took a long time to solve, and it was only until Alipay really started to digitize a lot of the trust. The things that used to be offline, getting to meet somebody before you buy something, they started to move that online with escrow services, chat, etc. Only when all those things were digitized did people start to move over to pure digital end-to-end transactions. And I think OTC is going to follow a similar pattern.
Yeah, maybe just to add that it seems OTC is very critical at the earliest stages as the digital finance ecosystem matures. I mean, if you look at the aggregate data, and I think the BIS has done very good research looking globally at how digitized transactions, how fast the digitization of transactions happen, it really is accompanied with a fast expansion of agent networks that assist in some way and provides some form of OTC transaction that gets customers used to whatever value proposition that wallet or that bank account is offering, right? So that gets the customer exposed to that value transaction. And what digitized the transaction or not really is a separate issue of whether the customer needs cash in or cash out to use the value proposition, because that is dependent more on the income sources that the customer has. If I'm getting paid part of my salary in cash, I will need to cash in order to use a digital service offer. Or if part of my expenses are still in cash, and not all of my expenses are digitized, I'm going to still need some form of cash out. So these are two separate things that I think we should carefully not mix, right? Now, as the value proposition expands the digitization of different customer income and expenses transactions, then you start needing less cash, which I think China is a very good case. But cash will never disappear. Even in China, you still need that cash in, cash out service point at a much lower level. We have a couple of another question actually that I think is relevant because I've heard a lot of stakeholders' concerns in terms of what is the role of agents to prevent corruption or fraud in this topic. And this is something that, at least in our analysis, didn't come up very strongly, but it certainly is a big concern for some regulators around the world. So maybe to ease that concern, I'd like to ask you, what is your experience in terms of fraud and corruption in agent networks, and how effective have the prevention mechanisms used by provider been? Maybe we start with you, Graham, since I know the Kenya model is and the India model is very strong on these aspects. You're on mute, Graham.
Yeah, I got there. So that's a good question. And I think we need to start with a couple of, let's be honest, observations. First of all, agents are very often the source of fraud as much as they are the target of fraud. So yes, poor agents do get very often sort of phishing messages, that spoof messages that come from, apparently come from their either their super agent or the provider themselves and so on, asking them to do things. But I think also routinely in many countries, they levy what are politely called unauthorized charges, which means their commission should be X% and they leverage X plus Y% on the transactions. And that, I think, is the most common, whether we call it a fraud or a rent-seeking arrangement, I don't know, but, it is very worldwide. But we have seen agents participate. I mean, I always think about fraud at sort of different levels. So there's the consumer level fraud, there's the agent level fraud, and then there's the institutional level fraud. And so agents, as Stephen said, are very often sort of key trusted individuals within the communities, and that's really important, not least of all because way too many times I've walked into villages and every single person's got the same PIN number, because when they set up the account, the agent, knows they're going to be doing those agent-assisted transactions, so everyone gets 5555. That's it. So that, of course, is, in some respects, begging for fraud. As I said, agents are targets of more sophisticated fraudsters because they're after the larger sums of money in float and so on. But also bear in mind that some of the recent frauds in Uganda and so on, at the institutional level, needed agents to cash that money out. And so, sort of 200 plus agents were involved in some of the most recent frauds on poor old MTN in order for them to access, the fraudsters to access the money. But the chief piece of fraud was actually done at the institutional level within the organization itself. So I think it's useful to think about fraud in those three different levels.
Thank you, Graham. Beatriz, would you like to react to this question?
Really have to say that stakeholders in our analysis in Colombia did not mention a problem with fraud. They did mention a problem with churn. And they did mention how they have developed technological data screening of the agents to understand if there's a normal behavior or if it's an abnormal. And if it's abnormal, then they stop the transactions at that agent, etc. And the main concern in Colombia has been with really how to manage risk, which is concentrated in a few individuals in each community, because everybody's going to them and signing contracts with them, either agent network manager or financial institutions. But fraud did not come as an issue in the Colombian case.
Well, it sounds that providers have come up with their own mechanisms to monitor that and prevent that quite successfully. Stephen, the Chinese case, has fraud been an issue at the agent level?
This is an interesting one. In many ways, agents were a reaction to fraud that was happening at the rural banking level, right? And so there were a lot of smaller rural banks that gained licenses in the early 2000s that were rife with fraud in terms of how they were investing deposits. And the agents were actually seen as a way to deliver financial services through a different channel that was more controllable, actually. And in China, you have another differentiator, which is a lot of the capital goes from bank accounts directly into digital wallets that are non-bank financial institutions, right, like Alipay, WeChat Pay, before that stuff is actually utilized. And so those fintechs actually have many different fraud mechanisms that are a lot more controllable because it's already in a digital ecosystem. And from a regulatory perspective, there is really clear tiering on how e-wallets work for non-bank financial institutions with very low limits in tier 1, and then you progressively have to KYC higher and higher through your bank in order to utilize more. And so from both those angles, the agents are actually kind of an intermediary that solves the fraud problem, and then they also passed on a lot of the regulatory fraud control to the non-bank financial institutions in the end.
Thanks. And maybe our last question, given the time we have, I think this is an interesting one. The question is, does cross-selling at agents help increase digital adoption? Cross-selling, I'm assuming, as agent networks become more open, or at least a lot of aggregation of services, financial and non-financial, happen, is this something good? And how does it help or not digital adoption? I guess maybe we start with you, Stephen, given the massive amount of service aggregation that we've seen at agents in China.
Is it good? I mean, if you look at unit economics, this will vary by country. In China, it's clear that not only was it good, but necessary for these agents to actually continue to provide the services in a way that was profitable, more and more profitable, I would say, for themselves. So, for example, in the beginning, a lot of agents were doing cash in, cash out as a social service because it was so unprofitable. You had to convince the agent to do it kind of as a nice for the community, and they followed that for increasing other businesses, and that was helpful. And as you continue to layer on more services because agents become infrastructure, I think you're able to see that the profitability continues to increase, and you're starting to see even different types of agents emerge because of how open the networks have been. So, for example, there's a lot of talk now of agents that specifically focus on the ag sector and are bringing a whole stack of digital services that include cash in, cash out, but also helping farmers sell, helping rural users create storefronts. So even sector by sector, you're starting to see innovation. And I think if you weren't able to do different cross-selling and have open agent networks, that innovation would very much be stifled. And so it's very country by country, I would say, but both on unit economics and potential for the future. It really is a hockey stick difference, I think, in the last 2 years in China because of how open the network has been.
Thank you. Beatriz, would you like to react to that question?
Can I leave it to Graham first?
Sure. Graham.
Oh, I was just left fielded. Yeah, I do think that offering a range of products is really important, unless you strip agency back to its minimum and make it a marginal add-on to another business. Now, when we did the agents count paper, which looked at the agent economics, it's actually surprisingly low number of transactions at agents that are non-dedicated, i.e. for whom agent businesses and add-on have to do. It's something around in the range of 5 to 7 a day. So if we see countries move to that differentiated model where in the market towns you have sales agents and then you have these stripped back minimalist service to everything service using technology. So they're training, they're onboarding, they're monitoring everything through technology. I can see a situation where even if I just did cash in, cash out, and maybe a little bit of utility bill payments as a marginal add-on to my main business, that would stand up. Mm-hmm. But if I'm going to be a dedicated agent, i.e. my sole business is agency, I'm going to need to sell a wide range of products.
Thank you. Beatriz, just to give you a chance to comment. If you don't have a comment, that's fine too.
No, as we were saying, for us, this specialized model, specialized agents has been really recent. It's very difficult to manage liquidity in those specialized agents. And for rural settings, they're not working. For rural settings, clearly, because of confidence, because of closeness to the final client, we think the typical non-specialized mom-and-pop stores, groceries, etc., still play out and work better in rural settings.
Mm-hmm. You say non-specialized, you mean non-dedicated, that they offer a lot of services?
Right.
Okay. Well, thank you very much. This has been personally very fascinating to hear, and it's very, very nice to see how after this analysis that you all led, we've been able to wrap it up with some cohesive messages. Thank you to all participants for joining us. And just to let you know that this webinar is a prelude to the upcoming publication of the Each Country Report that you will find a link to in the CGAP webpage, as well as the synthesis report that kind of discusses the main messages from this cross-country experience. So please be on the lookout for that. And thanks again for your time, and thank you to the speakers for making the time and sharing this great insight so eloquently. Thank you very much. Have a great day, everybody. Bye-bye.
Bye-bye.